All right, thanks everyone for tuning in. Today's topic will be on drawing fibs, and I had a handful of questions that came through over the week and over the weekend, so I hope to get to those, and we'll have plenty of time to go through all of your questions as well, and go through the markets and take a look at some things in real time. As always, first things first, a little housekeeping. Trading carries a high level of risk, and you're subject to lose all or more of your original investment, so don't trade with money you can't afford to lose, or money that if lost would affect your current lifestyle. The information in the presentation is for educational purposes and is not intended to be financial advice. The purpose of the webinar is to help you better understand the markets and improve your skills as a trader. I believe trading fits into our lifestyle, and really, a balanced life leads to that healthy life. And our attitudes influence our behaviors. So trading is a small part, but a very meaningful part of that bigger picture. So let's go ahead and get started. I actually have a little brief history that I wanted to share and start things off today. So, a lot of things that go on in the markets, it's important to, at least take a brief step back and get a foundation, if you will, for where these things come from. And being that we trade with the halfway back methodology using the 61.8 and the Fibonacci tool, it's really important to understand why it is that we're using these tools in the first place, and then where the numbers are actually derived from. And that can help in a number of ways, but simply just understanding the origin, I think, is really helpful. So the Fibonacci sequence, it starts with 0 and 1, and then the next number is the sum of the previous two. So the following number would be 1, and then we have 1 plus 1 is 2, 2 plus 1 is 3, 3 plus 2 is 5, and so on and so forth. So that's where the Fibonacci sequence is derived from, and that was Leonardo of Pisa, also known as Leonardo Fibonacci or just Fibonacci. Now, the origin was actually from Indian mathematics, but it was really Fibonacci who kind of brought the brought those concepts to the mainstream of the time, if you will. So what we have from the Fibonacci sequence is what's called and what's known as the golden ratio, and that's where that 61.8 is derived from. So what exactly is it? Well, it's in essence, if you take a look at a lot of things in nature, really, but for simplicity's sake, Fibonacci looked at the relationship of the parts to the whole. So if A plus B is 1, then A is 0.618, so 61% essentially of the whole. And that's that number, that relationship is derived by dividing one number in the series by the number that follows. So we have this series of Fibonacci numbers that's derived from adding the prior number to get the next number in the series. And if you were to divide, for instance, 2 plus 3 is 5, and then 5 plus 3 is 8. If you were to divide each number by the one next to it, you get the golden ratio. That's 61.8. So 5 divided by 8 is essentially 0.618. 8 divided by 13, 13 divided by 21, 21 divided by 34. Any number in the series gives you that golden ratio. And so it's this ratio that is really what makes up a lot of things in nature. And you've probably seen this drawing, and in that 61.8, 61% of the of this section is and then broken down into, this is 61% of this rectangle, and so on and so forth. This square is 61% of the larger rectangle, and you create this this series and this flow that is all balanced by the golden ratio. So I have a quick video that might help explain some things a little bit more. It's only a couple minutes long, but I thought it was interesting, and I just wanted to share it with everyone. All right, so that was just a quick little synopsis of the golden ratio and how some of the things are found in nature, and you'll see with art and things like that. So, um, the golden ratio and the Fibonacci is all well and good in itself, and we'll get to how it relates to trading in one slide. But there are a few other Fibonacci numbers that you've probably heard of more so in the trading world. And it's the 38-2, and that is simply dividing one number in the series by skipping the next number. So instead of to get 61/8, you would take 5 divided by 8 or 8 divided by 13. To get this 38-2, you simply divide 8 by 21. The next one, you skip one over. And then the other common number in the series would be the 23.6. And to get that number, you divide the number in the series by skipping 2 numbers. So instead of 5/8 or 5/13, you would simply take 5 divided by 21, and that gives you that 23.6. So those are the common fib numbers: 23.6, 38.2, 61.8. And okay, so how does Fibonacci then? How can we use that information and relate that to our trading? And we use the Fibonacci tool. Okay, that's all well and good. And you'll notice that the 50%, the 50 is really not a fib number. All that is the halfway back. So what we use the numbers in the Fibonacci sequence for, the 50 is denoted in the yellow line here. So the 61/8 is that golden ratio, and we're using that as the signal for the trend failure. So once essentially 62% of the move has gone against us, so if we're going in an uptrend here, and this red line is noted as the 61/8, once we pull back 60% of that move, 61.8% of that move, that's what we're using as a trend failure. And then the 23.6 is essentially the target price, and the way that's simply derived is really 20%, roughly 23.6% past highs, and that's denoted by the white dotted line. So that's kind of how we incorporate those numbers into the trade setups that we're looking at. So again, the 50 is really not a Fibonacci number, but it's essentially halfway back in the current trend. So then using the 61/8 as a sign of failure, and 23.6 or 123%, 20% past highs or lows is the target price. So these, drawing a typical traditional retracement, you simply want to start from left and pull to the right. So whether the trend is up, down, sideways, you always want to start on the left-hand side of the screen. So in this case, the left-hand side of the screen, if we started all the way to the left, we'd be drawing from highs to a low. And then again, from a high to a low, and noted in the picture here, we starting from the left, going low to high. But you always want to go from left to right. And you always want to go from some sort of significant swing low or high, or swing high to low. So I like to start on the larger time frames, and then drill down to the smaller time frames. So our entry then becomes the new anchor. So we're drawing from lows to highs in this instance, and then what happens is we draw from the entry that becomes our new anchor. Once we come up and we hit our target, we can draw the next traditional halfway back, the next 50% retracement. And we do that by pulling, instead of pulling from that same low all the way at lows, once we come up, pull back, and then trade up to our target, we're going to be drawing from that entry up to our target, or whatever these highs happen to be, and that gives us the next 50% retracement in the trend. And we continue to do this until that 61/8 is broken. So one thing I had a couple questions on is, what does the market do, or what do we do when the market really starts to take off? And that's when we go into what are called Fibonacci extensions. Now this is a little bit modified technique, but it's essentially the same concepts as the retracement. So again, we're drawing from left to right, and you'll notice here we have a traditional halfway back. So we have a low, and I just pulled up to the most recent high before the pullback, and that gave us a pullback down to, again, the yellow 50% retracement. Well, then look what happened. We ripped out. The market is not always going to pull all the way back to a 50% retracement. So what we have is the opportunity to draw an extension. And what extension is from a swing high to high, or a swing low to low. So what we have here is a swing high to high, as opposed to drawing from that entry that we had. And I'll just zoom back here. So instead of pulling from the entry of the prior 50%, we would draw from the high to high, because we broke and we traded extremely far past. We traded through the negative 23% target and kept going. So we would then draw from highs to highs, and at some points that does give us an opportunity to enter the trend again as it did here. Now, in most cases, or in some cases, it can become too late. We had this entry down here, so there's there's a lot of price action and things going on throughout the day, and by the time sometimes we get these large moves in the market, that's when people start to chase. So we're drawing from swing highs to highs instead of from a low to high or a high to low. And then, like I said, this would indicate a very strong market when we break out of that 23% target and we keep going. And like I said, that sometimes it's too late. So drawing the extensions are a good way to get in the trend if we're not at a larger price target. But at some points it can be too late because the setup or the entry has already traded, and the reason sometimes that the market rallies as it does or sells off as it does is because people are chasing, or people that were short here are getting their stops hit, and that's pushing the market higher. So you don't want to get caught chasing, and you don't want to get caught saying to yourself, oh, well, I missed the entry down here, so let me try to get in, because essentially you're buying this would be what would be essentially a bull flag. And sometimes those moves can be a little bit difficult to get in and stay in. So that's what I have for the kind of the basics and the overview of drawing fibs and retracements, and then touching upon extensions. So I thought what we could do is go through some of the market action and take a look at those in action, so to speak. So just some key takeaways from that is you want to go back as far as you can, and I like to, trading on a 15-minute chart, I like to go back on a 15-minute chart, and you go again from left to right, and you want to find that significant swing low or swing high, and then denote that the 61.8 is the failure level. So once that occurs, once the 61.8 is broken, then you simply draw the halfway backs in the opposite direction. So again, a good exercise to just go through and just draw all of the, you can do this on a 15-minute chart, you can zoom down to a 512 tick chart, and each day go through from, the Globex to 24 hours, and go from the, the very beginning of the day, and just start drawing all of the micros and the halfway backs in the series, and once the trend fails, then you just draw in the opposite direction. So let's go ahead and take a look and go through some examples. So everyone should be able to see my screen now. And again, I'll try to answer questions as we go, so feel free to jot them in the question box, and I'll pause and go through those as we go here. So if we are to, well, let's just take a look at where we are right now. And on the, we'll start with the ES here on the left. I go out to a daily chart, and if I make this full screen, you'll notice that still continuing in the strong uptrend. Now this is the daily chart, and I'm going to go ahead and delete all my drawings, and I'll draw everything back in as we go. So we were moving up nicely and moving higher. We then broke, had a brief period where we broke trend and had the what was the sign of starting a downtrend. If you go back to the Identifying the Trend webinar, you'll notice that breaking this prior swing low was actually pretty significant. And so then what we did was draw up the short, the first short in the larger time frame, and we had a brief pause at that point, and then we continued to rip out and go higher. So at that point, you say, okay, well, that's one of the instances where you have to draw the setup in hindsight. So you don't know what this low is going to end up being. So simply going back and finding what whether it's a big program that's buying, or whether it's just market sentiment and longer term investors that push the market. So the setup that happened to be working here is just from this low back here in January to highs, and we simply draw that up, and then we continue. Once we broke highs, you can just continue to trade that that uptrend because then we resumed the uptrend after that brief pause. So on the daily chart, we've come up and we've broken through a little bit that negative 23% target. Now typically we won't go to an extension until we really trade above, and I throw the 61.8 on there as well. And so if we trade up to that point, that's when, instead of drawing from lows to highs, as we would if we just traded up to the 23% target, if we continue higher and go up to this negative 61.8, then I would draw from highs to highs and wait for a pullback at that level. So identifying that, the daily trend is still ripping higher, and that's when we'll go to the 15-minute trend, and I can pull up. On toss, I can do 20 days max for 15 minutes. So we'll go to a 20-day 15-minute, and simply just going all the way to the left-hand side of your screen. And you'll notice, this trend here, each white dash line is a day. So, the last 2 weeks have been extremely strong and just very strong trend. And then if we go back here, we had a pretty defined trend of lower highs and lower lows in this downtrend. And if we keep going back, this action back here was the couple weeks, which would be the kind of the end of February, middle of February, that was just really choppy. And so it's pretty apparent, pretty clear to see the larger trend really makes a difference, and you want to pay attention when we're moving sideways in the larger trend. You don't want to get chopped up. So it's really important to start on the daily, start in that larger time frame, and then zoom down to the smaller time frames. So we're going to go ahead and we'll just start from this swing high. And so Gary asked if I have after hours on this chart, and yes, I do. I can, I'll show you how it looks. So this includes blowbacks. If I turn that off, it's much cleaner. So this is trading hours only, again with the Hakanashi. So it's much cleaner. Now you don't see the gaps with the Hakanashi, but I do include the overnight, the Globex session. And it's certainly okay to do either. When I'm going in this exercise, for example, and I'm going to draw all of the 15s in the trend, I like to use all of the data. And really the only time I will go down and just use trading hours only is when I'm looking at the gaps. So for the most part, yeah, I just leave it on Globex and continue to draw from wherever we are in the overnight session. So you can simply pull up a 15-minute chart and just start from highs and draw the setup, and keep doing that until we have a trend failure. And so, good example right here, if we zoom in, and again, this is over a course of a few days, but the exercise, and this is the same practice that we would be going through live, essentially. So we would have from highs to, which would be this would be the swing low at the time, and we came up. We traded the short, and we traded down to the target. And so it's at that point I would delete the first drawing and go to the second. And we had a so one thing to remember in hindsight is that just because the setups don't trade perfectly clean doesn't mean you won't stay in the trend. So yeah, Gary, Gary says this setup is a little bit dirty, and that's exactly right, meaning that this first setup came right to the 60, right to the 50%, and then traded away. Well, this next setup did not. So before you discount it, you have to remember that if you're using a 6-tick stop, if you placed your entry at 50 or a quarter, you want to go up here and look at the high and see, okay, 67 and a quarter is the high. So if you placed your entry at 65 and a half, or 65 and a quarter even, you're still in this setup. So sometimes that's why it's good to make notes during the day, because when you go back and go through the trades, you want to pay attention to those sort of things, because this would be a trade that if you took it at the 50, you would be in And again, using that 61 as a failure, just round up. So this happens to be 66.99. I just round up and add a tick. So I would say 1367.25 for a failure point. So I would just continue to draw those in the trend. And then once, so then, okay, we came down to negative 23. And now here we have a setup that that did go through and it broke the 61.8. Now, typically, okay, so the time on this is in the Asian session. So this would be kind of that overnight overlap. But just going through, okay, now we have a trend failure. So we would delete that and we would draw the opposing. And that's where we also had a break. And so breaking the 61.8. And now keep in mind, this is so this is after hours, but if I was waking up and it was about 7 o'clock here and I'm getting ready to trade and this whole section happened overnight, that's again why I don't I set myself to specific times to trade. So this is all overnight price action, so my last drawing may have been here, and so I just wake up in the morning and then continue on that Globex, as Gary had mentioned. I stay on the Globex and then draw all of the setups that happened overnight. So then I would come up and see, okay, now we traded to the 50%, and then we sold off and we broke down even through the 61.8, which is extremely bearish. So drawing from lows to lows. Now at this point, we barely made it up to the extension, and that's just an extremely bearish in this case because we're trending down. Extremely bearish sign. So going again to have another extension, drawing from lows to lows, again barely making it up to the 50, and just continuing lower. So just continuing to do this exercise. I would then go, okay, if we had from lows to lows, you can either continue at this point, being a little bit more conservative. You can use that same anchor to low and use that 61 as your failure, instead of going from making it, they get tighter and tighter, so then you would be extremely small, but the same concept applies. If you're using the 61.8 as your failure, we broke, you can simply delete that drawing and then draw in the opposite direction, and then start trading longs. And in this case, we didn't come back down yet, so we just wait for the first swing high that we pulled back, and it happens to be here. So okay, now we got that low to high, the traditional, came back into the halfway back long, and then I would continue that process all the way through up the chart. And keeping in mind the bigger picture, that 15-minute long happened to be basically right at the daily entry. So if I flip over to the daily chart, that 15-minute long that we were looking at, where that trend changed, happens to be right at that daily level. So just going through the chart in that manner, I think, really helps to kind of solidify the setups, and then really get those setups ingrained in your head. And then when you see those setups during the day, there's no hesitation, or there's less hesitation. And I think that's one of the things that really helped me kind of boost my confidence and get over the fear of pulling the trigger, really, is going through every night and on the weekend reviewing the last few weeks and just going through setup after setup on the 15-minute chart. And then I would go even so far as to zoom into a 512 tick chart and draw the setups and identify them, draw them, and just watch them work over and over again. Okay, so a couple Garys in the room. So another Gary asks, if I enter at the 50 and we trade through the 61.8, will I exit the trade? No, I will leave my stop at 6 ticks. Most of the time, 6 ticks is just outside of the 61.8 on the 15-minute chart. Sometimes it's not. Sometimes it's right at the 61.8. But I will leave the arbitrary 6 ticks because sometimes it is dirty. Sometimes it goes right to the 50 and trades away. Other times it dips in a little bit. And so I'll just leave my initial stop at 6 ticks. And then yeah, other Gary A asks if I don't get filled. So if I put my order in and I don't get filled, then I won't chase it. I'll either wait for the next setup, because my view is I'm already putting my order in front of the halfway back, and if it's really, I would say, rare that it comes one away or two away and I don't get filled. But if I don't get filled, yeah, I'm in the habit of not chasing or not dragging my order up a few ticks, because you never know if it's continuing towards your fill or if it's pausing. I mean, reading the tape and watching the dome is a valuable skill, but in my personal trading, that's kind of what drew me to this methodology, is simply placing my orders and letting the market come to me. So I'll put my order in front of the 50%, allow the market to come down or come up to my order, and let the market fill me. Let's see. So Kevin asks about keeping in mind the trend on the daily chart. Yeah, that's one thing to really keep in mind. And so on the daily chart, and I'm going to go ahead and just move over to the euro for this, just because it's a little bit easier to see. So I'm going to go to a euro daily, and knowing where we are in the daily trend is really important. So if again, I'll delete these lines and redraw them. So if we zoom all the way back here, because the euro's been just extremely technical, both with the entries and then the failure, it's a perfect example. So here we have a daily entry, and drawing from lows to highs, left to right, and looking at, okay, we have an entry on the daily. Now, whether you took 29.77s or you waited for the first 15 or the first micro, identifying that now we are in an uptrend. So we're looking at longs all the way up to this negative 23% target. And they're going to be higher probability the closer that we are down to the entry of the larger time frame. So on the 15-minute chart, any of these 15 minutes that are down here are just going to be the highest probability, versus taking a 15-minute long right at the negative 23% target, and this other yellow line here happens to be a weekly, a larger term short. That's going to be a lower probability trade. So we traded freakishly tick to tick or pip to pip here on the euro, and simply drawing the next 15 in the series. If I were to zoom in, you'll see we have a little bit of bounce here, and we go up and then we fail. So we broke the 61.8, and so at that point, what I would do is delete this drawing and then draw in the opposite direction. Now I'm going to do two things, actually. I'm going to draw the opposite setup. So now we have a short, which did happen to trade, but I'm also going to draw the full opposing long. And if I scroll back a little bit, it's at this point when, it might be a little bit hard to see if I zoom in. So it's at this point where I have the short drawn and I have the long drawn, and it's going to be whichever trades first is the trend that I'm going to go with. So we have this swing low back here that's kind of down near the 61.8. So that would be a very strong signal for the bears if we were to break this level. And then we also, so we have the short up here, and then we have this potential long before that break. So we did happen to trade the short first. So the short traded at 32.92, and I think that was on an afternoon, right at the nicey close, I believe. And then there were 15 minutes set up. So at that point, I'm looking at keeping in mind that we have this big now, and also, so keep in mind that these are hundreds of points in this price action on the daily. So we have this big daily, weekly, whichever way you look at it, short above us, and this big potential daily short below us. We had broke the next daily long in the trend, so I just drew up the short. That short traded first, and then we came down, and that negative 23% target happened to line up roughly with this long. So with this daily long. So trading shorts, because that traded first, that's the daily trend that I'm going to go with. Now again, since we have a couple of different trends, essentially, halfway backs at the same time, it's whichever trades first. So that's just the rule of thumb that I use. And so then this one traded short entry to target, and I would just draw from entry to target. That setup traded briefly and broke. And so at that point, yep, exactly, Kevin, now we are in longs, and so the 61.8 had broke. Delete that one. And so now we traded at the long. Keeping in mind the short hasn't broken yet, this big weekly short, but the immediate setup, I don't want to be, I don't want to be taking shorts right at this point. So if this is where we are in the daily trend, I don't want to be shorting at the negative 23% target of the short when I could have got short up here. And I don't want to be getting short at the potential daily long. So that's where keeping in mind the daily trend is really valuable. So now just drawing up the full long and keeping in mind that we're kind of bouncing in between this long and the short is what I'll pay attention to. So now that we have a long traded and a short traded, I won't go in here and start drawing halfway backs in the middle of this series or the middle of this range, so to speak, because now we're just in a range at this point. So we'll be looking for longs up into, again, the daily, this big weekly short, and we'll be paying attention to whether or not we break highs and continue to the long target, or whether or not we break lows and continue down to the big weekly target. So that's looking at the bigger picture, but now on the 15-minute chart, I'm going to be keeping my eye on this 3141. If I zoom into the 15, we've kind of gone up really far, really fast, again in those extensions, going from highs to highs, and then at this point, going from high to high, and looks like that one just came down to the extension. But I'm going to be looking at this 3141 as the potential next area to start taking 15-minute longs. And, keeping in mind that, yes, we did kind of go parabolic the last couple of days. So, this is a less higher probability setup, this extension. I don't find myself going, when I go back through my notes, I find that I don't take that many extensions and when I do take them, it's only on the 15-minute charts. So I'm not going to be looking at a tiny micro extension, because at that point, so many of the, if we're on an extension in the micro time frame that's so small and kind of identifying that we're at a top or a bottom. So at least on a 15-minute chart, we get some sort of pullback, because this is really a bull flag. We've rallied, we've pulled back a little bit, we rally strongly, we pull back a little bit, make that kind of bull flag pattern, the pennant pattern. And so I don't want to be taking a little tiny micro up here in an extension because we've just rallied, so far so fast. So looking at the 15 minutes for the extensions, but again, kind of, a lot of the times there was an entry, or there will be an entry on a traditional before that big catastrophic move. Just flipping through some more of the questions here. So Eric asks, what drives the decision to trade from either a micro or a 15-minute? Now on the euro, on the ES, I will only enter or I'll use the 15-minute for my entries, no question. It's just easier to see on the 15-minute chart. So if I go to the ES, a 15-minute chart, I'll draw up the 15 minutes. And this morning, I can zoom in a little bit, but this morning was actually very tight and a little bit slow, so there was almost non-existent to see on the 15-minute chart. So that's where I will go ahead and zoom to the tick and then draw the larger setups that are visible. It's visible on a 15-minute, but just a little bit hard to see. So on the 15-minute chart, we have a low to high. This is pre-market that was fairly dirty. There really wasn't a gap fill setup. There wasn't anything that was really going on in the morning. But then we ended up trading off of, if I can, let's see, I will note, this is, yeah, here we go. This was the low of the morning. And so this is the first half hour's range. Delete this. So this was the first 30 minutes of trade. And we, so then this is 9 o'clock Central Time, about here. And so what we had this morning in ES, I had 2 trades, and we just, we traded off this 15-minute, which was a hindsight drawing, because you really didn't know when it was this setup, because we didn't come into the full down here. So this setup traded. I drew the opposing short to watch for that failure. We broke the 61.8, and so I drew up the next 15-minute, or the next, it's on a 512 tick chart, but it's larger, so it's visible on the 15-minute candles. But it just, it's contained to 1 or 2 candles. So drew up that one, took, I think it was 13.9975s. Didn't really go anywhere. I drew up the next setup and trailed the 61.8, kind of tight, hard to see. We kind of topped out here and sold back off again. And at that point, we broke, let's see, what did we do? Yeah, we had, so then we rallied off of some arbitrary level, and that's where I will tend to draw. So okay, this is the first hour or so's range, and this is the low and the high. So we went through the first hour and a half of the morning, almost 2 hours of the morning, moving sideways and moving sideways, moving sideways. So once we identified the first half hour, which was the first 30 minutes of trade, I drew up trading hours only, and that's what happened to be holding at that point. So we traded off at once, didn't break highs. We came down, traded off it again. I drew up the opposing, watched for that to fail, and we failed. Again, I just used that 61.8, and so I drew up the long, and that's where I was able to get in and then trail my stop behind each 512 all the way up. I think it was 625 is where I was finally stopped out. So I just trailed all the way up, trailed the 61.8, and then taken out. Let's see, it was here, and then, yeah, because my stop was up under this kind of consolidation. And then so I used the 61.8, 40.51, and then so I just put my stop below there at 625s. And so that's kind of, using the 512 tick, but keeping in mind the larger 15-minute entry. Now, Jerry, I don't use range bars. I'm actually not really familiar with range bars. I've had a couple people ask me about them, but I'm not well versed enough to speak about them or make any comments. But I do know a few people who have made some comments about them, and both positive and not so positive. Yep, that's right, Gary. Got that. Let's see. So I digress a little bit, but if I zoom back over to the euro and go through today's, so today we had the traditional on the ES, and then we had the extension today on the euro, and there really was not any real sort of entry, I suppose. I was waiting for an extension that didn't happen, and so that was today was just those 2 ES. But again, on Monday, looking at Monday and Friday kind of easing into the week and then easing out of the week, the goal is, as I like to say, not to be a hero and not to make your week on Monday and Friday. And that's why I limit myself to the one stop out on Monday and Friday, which might seem, really conservative, but I think that's what keeps me and has kept me in the game for so long, and keeps a lot of, bigger traders in the game, is that, they will contain themselves And I think contain is a really good word because, you start to let yourself go and you say, oh, it's only Monday or it's only Tuesday. I took a stop out and I'm going to keep trading. And then, okay, I took another stop out. Now I'm down, 3 stop outs on Monday. And going into Tuesday, I'm saying to myself, well, now I have to you get in that mindset of having to make it back, which I don't think is a very good place that you want to be. So Monday and Friday, I just limit myself to one full stop out. So meaning if I don't even get any sort of first target hit or any opportunity to tighten my stop, I say to myself, okay, something's up. And rarely does that happen with the euro especially. I think it's about 78% getting those +4s hit. So if the trade's not even getting some sort of bounce at a 50, I step back and say, okay, something's up. So I kind of use that as my indicator of, okay, using 1 stop out on Monday and Friday, and then 2 during the rest of the week, Tuesday, Wednesday, Thursday, 2 each day. That really helps to limit myself in case, the market is not conducive that day, or, there is some sort of news coming out or something else funky that's going on. Those kind of rules help, and I think are really so much more important than whatever the system is, because, if you have a system and you don't follow any sort of management side of, reducing the losses, and essentially, so you have this statistical set. Again, as I digress, you have this statistical set of data and these probabilities, and what you want to do is manipulate, in a sense, those probabilities so that you cut down on the losing trades, and you do that by placing stops. You can do that by making your winners larger than your losers. You can do that by, increasing your winning percentage, at the same time increasing your the size of your winners. But then the other way that I like to do it is to make sure that any losing day that I have could, easily be made up by 1 winning trade. So if I limit myself to 2 full stop outs, say my first 2 trades on Tuesday are, stop out, which another instance that, just going back through my notes, is extremely rare that I've found to have back-to-back stop outs. So, that's why I limited it to 2, because that was my signal that, okay, something's up if I have back-to-back stop outs in a row. So, every once in a while they do happen, and then I simply stop trading. And then what that does is allow me to, again, not liking the term, but make that back in essentially 1 trade. 1 winning trade can easily make up for, 2, 3 stop outs. So maximizing those winning trades and then limiting both the losing trades by placing your stop and then the number of losing trades, because yeah, it's great if your winners are 10 times your losers, but if you only have 1 winner in every 20 trades, well, then the numbers don't exactly make sense. So not to digress too much from the fibs and drawing the setups and things like that, but that's also a really important topic that we'll go ahead and cover in some upcoming webinars, talking more about being able to maximize those winners, and then some strategies for limiting the losses that are kind of aside of the strategy execution standpoint, but more of the hard on paper physical kind of aspects of trading. So just touched on that. Mike, yep, got that right. John, yep, that's that's how I would see that. Okay, I think I touched on everyone's questions. Bill, appreciate it. Yeah, thank you. Matt, I don't currently trade 6A. I've looked at a few things, gold, pound, and some other currencies and stuff like that. But yeah, the 2 markets, the ES and the Euro, I've found for right now to be my kind of bread and butter as far as the futures markets go. Yeah, looking at the Russell YM, also good trading vehicles. But yeah, other than that, I really stick to those two as far as futures, and I really enjoy that combo. And yeah, thanks, Kevin. I am feeling better from last week. I had a little bit under the weather and drove back from Arizona, so now I am stationed back in the Chicago suburbs. I'm a little bit north of the city. But yeah, feeling great. Weather's here is fantastic, and looking forward to spring and summer. So I think we'll wrap it up for today. If everyone, I think we got everyone's questions answered, and I'll go ahead and encode the video and post it up to the member dashboard tomorrow morning. And I hope everyone has a great night, and we will talk to you next week.